Good evening. This is the Eye of the Storm podcast for the S&P 500 and the NASDAQ 100 for Sunday, September the 11th, 2022. As Globex begins this Sunday evening, the markets have, or the equity indexes have gapped higher and just now are beginning to pull back and showing red over what Friday's closes were. In any case, I'm taking the opportunity to use this particular podcast to go over that view number two, because in my opinion now, that the market, even with the gap higher and now kind of turning into more of a red bar in the daily, which leaves it, and it's a blip, you can barely see it, but there it is in all its glory. Kind of flat and like, okay, what am we doing up here away from everybody? In any case, I think it's important that we put some understanding to that count and to what the possibilities can be. So let's take a look. So moving it over, I still have as view number one, the fact that the primary B wave ended here at 43.27. And in the NASDAQ, that would be 12,741. So that once there, we began to go lower in a primary C wave, or what we are labeling as the beginning stages of a primary C wave, which will consist of 5 waves of intermediate degree. Now where this all then goes, let me just dip down real quick. Down here, you see we have intermediate wave 1. That was and still remains view number 1, but I've left it now over here so that I can show view number 2, which would suggest that this did not complete a C wave. So it's dropping everything back down a degree. And even at the time when I brought it up, I had basically said, because I changed it from minor up to intermediate, which then put that primary B there. And I also discussed that oftentimes I and others can have a tendency to count too fast. And that would be with relationship to degrees, versus that these lower degrees are going to take just as long. Then you're thinking that because it's just so much time. So, but when we take a step back, it's like this high, and what we're talking here, I think, is the September 6th low to that one. That's not the one I'm referring to. I'm referring to this high, and this was in August. That rally that this started on began in June the 17th. So basically a month for the market to put in, which would be the intermediate C wave and primary B, or intermediate wave A. So I dropped it all back down a degree. Now, then, so this would be wave 1, and this would be an intermediate wave 2. Now, on the other hand, if I move it over and I'm looking at this being intermediate wave A, this being intermediate wave B, of that larger primary wave B, still in a rally phase. So again, let me go back out to that daily chart. The B hasn't occurred yet. It's still, the whole umbrella sits underneath this or above it. And we're still needing an additional rally to cap it off in the form of an intermediate C wave. So the initial was that this got counted as intermediate waves. These got counted as minor, and this ends up being an intermediate wave C, primary wave B. Now, what gave that pretty strong support was the August expiration, or the move, and actually it wasn't August expiration, it was a Friday, so it was, the expiration was right in line with the Jackson Hole speech. So what the market did on that day, it dropped. They all did. The Dow was down 1,000. The NASDAQ, I think, was down 115 or 20. The S&P, the NASDAQ was down over 500. So major drops, the market then continued to go down, which gave credence to this count, and that it was a primary C wave down kicking off in grand style. Then that this low back on that hourly chart. So this low at 38.83 was the low for intermediate wave 1 of this primary C wave. Beautiful, fits, everything's lined up. Now talking about that intermediate B wave completing there, and what we're going to be going in is an intermediate degree C wave. That intermediate degree C wave will consist of 5 waves of minor degree. The other count suggests that intermediate wave 1 of primary wave C going down finished here. And what we're now tracing out is an intermediate wave 2, which will consist of an A, a B, and a C wave. This can be labeled A, this can be labeled B, and these would be a 5-wave structure up to complete wave C. Expectations on all of the above, really, if it's just an intermediate wave 2, I would be looking for this to be 1, 2, and then 1, 2, 3, 4, 5 or 3, right? Minor. Or if we're looking at A, B, and this is 1, 2, 3, 4, 5 to complete C, to complete intermediate wave 2, we can run Fibonacci retracements of this decline, and that'll give you also wave 2. And I'm sure we could, what it can do is it cannot go above 43.27. That would invalidate an intermediate second wave. So here we are, and that's why I'm talking about it now, because now we're comfortably, or we had gotten above 4,100. We seem to be okay sitting above 4,000, which was just re-achieved on Friday. So again, we have underlying market strength, I want to call it, to continue to push higher. And it'll really have nothing to do with the fundamental reasons, or just the underlying reasons that the market is more concerned with. The economy and the US is ready to go into a recession. In fact, they're calling for a recession. They're calling for all this stuff. We have enough things going on within the country, enough things going on in the government, enough things going on in the world that could shift tone and shift market direction on any day at any moment. Because we're always waiting for the next shoe to drop. But right now, it's kind of gotten a little bit quiet, so to speak. And so we're not expecting the Fed to really mention it, to really be out there talking it up until their meeting, which I believe will be in another week or so. So we have things out there. So it is almost natural. It's just a bounce. It's just a recovery over some solid and stronger down phases. So if it is the C wave, the intermediate C wave, the Fibonacci extensions are here for wave C. Again, quickly going to the daily. What we have is wave A and wave B. So we now, under the other count, view number 2, we can take a look to see where should this C wave, what is the potential? Well, obviously, it's going to break 41.46, it's going to break 42.27, and it's going to break 43.08. But 43.08, 09, 43.10, whatever you want to call it, would be basically acceptable. It would be a slight failure to get above that high, but it would be acceptable as a small failure. But normally what that would suggest is whatever's going on, the quick turn. So this is where something would happen. Boom. You get some kind of news, you get something else, and it just then turns, and that would then complete it. So on a Fibonacci basis, and also as long as we can complete it on an Elliott basis, hopefully under one count, or if it is, if it's this count, it can't break above that level, 43.27. At 43.09 would not. So technically both counts could run all the way up to there. Now, the C wave count can have and can go above 43.27.28. Then we're looking at what's the next Fibonacci relationship. The first being that the C wave is equal to 0.618 of wave A. That points to 43.09. Then the C wave would be equal to wave A. That points to 45.72. And the outlier would be that it could go up to here. And if it does, we run the risk at the S&P. I know it's not something that I think can happen or should happen. But the current all-time high is 48.08. If this particular primary B wave decides to be an irregular, which I don't actually think it should, but it can, because what came before it was 3 waves. So there's a lot. I don't know what would propel it, but there it sits, and you can see it, 47.30, 48.35, 49.97. 1.618 is the Fibonacci relationship that would go. 1.382 would be the one that goes with an irregular, and that's not beating the other all-time high by much. But yeah, and it's out there. I'm not saying it's going to happen. I'm not saying that this is the boost that the market needs. I'm just laying out what is included in pattern recognition, and not that I am looking for that. I'm not. I'm taking it day by day. Now, wave 2, intermediate wave 2, we know we got this, and that should contain it, and we should be able to count 5 waves, and minor A, B, and C. So 5 waves for the C wave, of which we're in the 3rd. Look for a small pullback, then you get the 5th, and that 1, 2, 3, 4, 5, and then we're done. And it's 41.50 to 42.28. Yes, where you have relationships, but I can run A, B, and C and throw up a different set to go with that. And that's A, and this is B. And then I'm just going to take these down for a moment. So what we have is, if this is A, B, and C, so again, we're under view number 1. We're looking at this a little bit differently. Like, it's not just going to explode and move above. But here, we can put some additional parameters around it. If indeed it's A, B, and we're putting in a C wave to complete that intermediate wave 2, then you're looking at 41.24, 41.34, 41.68. And those are pretty big numbers. It's already zipped past 100%. It's already zipped past 1.2363. It's sitting right at 1.382 right now. So that would be next level, 41.24. And that all can stop. A, B, C, 2. Turn, drop. So that's what you would look for on that one. On this particular count, if this relaxation period, if this period of recovery continues, these are those other levels come into play, where we're looking for the market to go up above 43.28. And there we have those upper levels that I took down. But they're up above 43.28. And we're looking at a possibility of 4,400, I believe. We'll run them again if it's really going to show. But I wanted to be able to talk about both, lay it out cleaner, basically because of the gap up. That just suggests we should continue to see follow through. If they come in and kill it, then it's going to leave it as an island and that it is a negative situation. Now, what I also wanted to talk about is how are we supposed to trade this? How are we supposed to look at these different things? How I want to lay this out again is more on an Elliott basis. And it's going to be the same whether I'm talking about the NASDAQ, whether I'm talking about the S&P, and I will go over the NASDAQ in just a moment. But in trading, you can, well, where do I begin? We have the two views, the two counts. They're not totally diametrically opposite of one another. Both at this particular moment call for additional upside. One, I can put limitations. The other has it up above this other's limitations. So how do I want to trade that? Me personally, I'm a day trader. So I can come in and adapt to whatever the market is doing. So I do continue to trade looking at price action. I do continue to trade not really based on a daily chart, not really even based on the hourly chart. I look at the hourly numbers. If we're looking for larger moves to kind of come in and kick in, you definitely need the help of your hourly chart to give you directional guidance on larger upside or even downside moves. What are the limitations that the market can possibly do on that day? Some of them will seem like, oh, never, won't happen. And the next thing you know, there it sits. So again, working these out so that you've got these numbers in your mind or written down so you can make reference to them, help you choose positions. If you're an option trader and you're looking for, you see this rally happening, and now you've got levels that are pointing higher, if you're feeling strong enough that that's where the market's going to go, you begin to look at what the premium is telling you and where that sits. And so you're going to want to be taking advantage of premium. And most of the time, or a lot of times as an options trader, you either want to be in a defined risk, in that case, a spread, or you want to be taking advantage of the directional change. So you will likely, if you don't necessarily want to be buying premium. So you're going to have to figure out how you can sell the premium that's going to be available and still reflect direction. And you can put strike prices, or you can put prices around the possibility. Where is the resistance? And then how does that line up to particular strike prices, et cetera, et cetera. And there are other, if you're trading an individual stock, then particularly if you're trading Apple, there are many different things that you could do with the options. And that's really what's going on. Because again, as I said, it's not going to have a whole lot to do with what is the underlying causes of a lot of the negativity, a lot of the downside, and the expectations for additional downside because of inflation, because of higher interest rates, because we no longer see that light at the end of the tunnel. They've not really gotten a hold of it. They're telling you got to remain strong, et cetera, et cetera, et cetera. So it's like bracing us for what's coming. If you go, yes, crude oil prices are coming down, but they're still closer to 100 than they are to 50. So, and depending where you live, there's just many, many functions within this. But let's just leave it to say that if we follow the price action, everything that's happening economically, everything that's going on, as it resolves, it will be reflected into the market. Therefore, I cover two views, two ways to view the market, two ways to look like how high can it go and not change that larger picture. And then how do I want to trade that? These are important things because they're not impossible. So if you stick to like a quantitative view, which is what option trading really is now, then you take advantage of trades that don't necessarily have a high dependence on direction. Most do in one way or the other, but you're putting them on because of premium. And there are directional premium plays for sure. But there are ways to limit risk. Let me put it that way. All right, so back to the markets. And that goes to no matter what you want to trade, if you have an idea, if you have a thought about where a market can go, and you've got your picture put together about the economy, about what's going on. You can't be blind, but we can follow price movement. You're looking at where a price is going, where's value, where do buyers and sellers get to meet, and who's actually putting on the demand, or where's the supply and demand. So it's changing how you want to look at it as well. And if you're really looking at it, you say, well, they're in demand. Everybody's looking for somebody to sell it to them. Everybody wants to buy it. But whatever the reason is, who cares? The fact is, it's going to go. And so you need to just determine what you're going to trade and how you're going to trade it to make the money out of the move without trying to quantify or qualify the move itself, because often they happen quickly and you just have to change and you have to find the trades. And some of them come in the real juicy, and your competition is out there searching for them as well. And they have very expensive algorithms that do all the work for them. So again, trading is trading and the opportunities are there. I, again, prefer to day trade. That allows me I follow the price action. Anything that happens in any of these stocks, yes, I do call out Apple. I do like to keep an eye on Apple because it's the heaviest weight in the S&P and the NASDAQ. So if they're not really moving that, then I'm kind of looking for the others to sputter and cough and carry on. If they're really moving Apple, well, then I'm looking for the others to go in the same direction. So it's just a little bit when you're looking at price action, because more important are other factors. We have moving averages. We have when you're trading and you're using the volume order flow, that also produces points of control, value area high, value area low, naked points of control. Remember, no, actually, you probably wouldn't, because I only basically said it in my trade room where I talked about, this would have been on Friday, we have higher levels of, they're just extended value area highs that got put into place and never really got challenged or broken. So there they sit, still waiting. And the market goes to them. They still remain in the number system, on charts. So when you're programming, it's like, where do you want to go? Go to that point. It's still there. It's still telling you that's where value will be. So when all the numbers change, then the market will as well. Now, over in the NASDAQ, it's been a beast, but I've done the same thing. I haven't filled in as much here on the NASDAQ because it gets real clogged real quick. But I am looking at here on the 1 hour chart again. If we are looking at an intermediate C wave to complete primary wave B, what are the possibilities of what this market could do? This actually is just the very, very short, near term. So I'm going to go, well, I got to put one other on there, folks. So I got to get rid of that one real quick. Yeah. And I want to go back out to the daily chart and put on an AB if we're looking for that C wave up. That would be the biggest one. There, there, to there. Okay. So again, back out to the down to the hourly. Now we have what we're working with. And if indeed we're looking at a C wave up, inside that intermediate degree C wave would be 5 waves of minor degree. And I use this color and those Roman numerals. So it's -1, -2. We're in a minor third. 1, 2, 3, maybe 4, maybe 5. Possible. Or are they minor? Because our first stop would be 13,572. That's kind of below 13,741. So again, we'd be looking at a small failure, but hey, this is kind of cruising on air anyway. So a failure would not be so bizarre, would not be so totally out of the water. But beyond that, the market does have potential where wave C would be equal in length to wave A at 14,594, 95, 14,600 up in this area. All-time high again for the NASDAQ, 16,768. So still pretty good distance up there. But getting back closer to 15,000, when we've taken a look at the overvaluation across the board, where you've seen the volatility shrink because of the stock splits that Amazon, Google, and Tesla have done, almost back to back. And so we've seen a lot of contraction that way. But now to see it kind of come back, it would drop the mindset into a place that I don't even want to talk about right now. But if we stay focused on the price action, we stay focused on not the reason why, oh my God, why are they buying it? Are they going to take this to new highs? I don't really care. And I have no idea why someone would massively want to shift an entire position. But you can trade it. You can trade it. That's my point. You can trade upside and downside. Do not take a bias to the market. Don't be bullish. Don't be bearish. Step in and trade it. That's what's important. You will make money. Again, I'm a day trader. It does put a whole different spin. I'm trying to pick a side, stick with it, and wait. That would make me crazy. So I believe there are other ways you can trade this and still be participating in the upside and being prepared for the downside. If you're going to be an options trader, then you go trade those options, and there are ways to do it. A futures trader, I prefer taking that on a day-by-day basis, and you can see why. The movements are rather large in terms of money. So you can make your money on a day trading basis and just be done and go have a good time and not worry about anything else. Now, the NASDAQ for tomorrow, this is the hourly chart. Let's see if I can open this up and bring it back into focus. So for tomorrow, I would think that what we're doing right now is minor. So if we're in a minor third, then we've got minute waves. So it's minute 1, 2, 3, 4, and 5, and that'll complete a minor third up here. And ultimately, our first stop as a minimum is 13,572. We're not even above 13,000 yet. Got to do that rather quickly. So we could really push higher under the second, or view number 1, excuse me, where we completed intermediate wave 1 at 11,919, I think it was. What was that low? Right there, please. 1921, yeah, 11,921. That at that low would have been minor 5. So that's leaving those minute 5 and minor 5. And that then completed that intermediate wave 1. So this would be minor A, minor B, and we're in a minor C wave to complete intermediate wave 2. Minor C can go, I think I can just open this up and let's do one more just because I'm here and I can. I'm going to quickly put this on here, there, come on, to this one. And where we have on these is 100. If they just came up to 618 is 13,045, 50%, 12,831. That would be almost the next stop, right? It gapped above 382. So on Friday, it closed below 382, gapped above it, now holding well above it, which puts in a positive that we should see follow through to the upside. So next up on resistance wise is 12,831, then 12,942. Then we have 13,045. We also have 13,572. So there's our 618s. This would be an ABC, and that C would come to 13,045. And then that is where wave C, and you could run another set, A down to B, and that'll give you that. So just straight Fibonacci retracements for a wave 2 are up to 12,831 to 13,045. Now I'm going to take that down real quick, and I'm going to really, this is probably getting pretty long, but thank you for sticking with me. Let's take a look at where we can do this. Again, I'm going to go back to extensions, and I'm going to put them from there to there. Oh, I got this right, this one. Thank you. And that actually has 12,774. So we're now even honing in deeper. If we're moving this, I'm a little bit off. Maybe even comes in close. I'll leave it there for right now. But we can say that wave 3 actually would come in at 12,783. Now I can change that. Edit by moving that down. 12,306. No. Beginning is there. Midpoint. 06. And say, okay. Brings it down, but actually that puts us right there. So we have a lot of different things. We can have intermediate wave, minor wave 3, which is what I was saying before. We get a little bit of a 4, and then we get a 5. So there's a lot going on. We have a lot of Fibonacci levels. So it could be, choppy. It could be many different ways of trading this. Again, we'll have to wait and see. Again, this is the hourly chart. If I come down and put it on the 30-minute chart, you can see a little bit more action. So I'm going to leave it there. There's enough going on, but I do think we have a little bit of more upside to go. So the reason I'm kind of laying it all out so that we're not surprised and we're not afraid to approach the market from the long side, because that's really where I think they'll come from. But we have to stay open, because when the sellers show up, they're just going to sell, and the market will drop. So be open to both sides. Our next update will be on Monday, September the 12th.